Don't wait for tomorrow. Live for today. Keep chasing the sunshine and go out and play.
Good day, everyone. Welcome to another JK Deal Reveal. Today, we are going to have actually a part 2 on last week's deal reveal because last week was pretty amazing. And I wanted to give you a little bit more of an inside scoop on the negotiations of the deal because this is a real live deal that's being negotiated right now. And a ton of things have changed along the way, and I wanted to give you a little bit of insight to see if now it is a deal or no deal to ultimately purchase Wizards Way, the original Harry Potter house in Florida. So if you haven't already checked it out, just Google Wizards Way YouTube or Wizards Way Airbnb, and you're going to see what I'm talking about. Just go check out last week's deal reveal. I gave a nice, good scoop on it. So, stick to the end. There's going to be a little giveaway for you like there usually is. And if you have a deal you'd like me to review, do a deal reveal, if you have a deal that you'd like to have featured, that you have questions, or if you want to get the my opinion and the community's opinion on if this is a deal or no deal, it's always the same thing, guys and gals. Submit it to info@nowfortomorrow.club. Simple as that. If you have any questions about our blueprint, if you have any questions about our programs, or the support that we can offer you on your U.S. real estate journey, info@nowfortomorrow.club or success@nowfortomorrow.club. If you want to start swamping us with emails, that's how you do it. All right, so this is the property here. We're getting excited because in a very short amount of time, you're going to get a good sense about what this deal is about. And you'll notice right away that the purchase price is lower than it was last week. We are at 1.14682. I think it was missing a number. $1 million. All right. Original asking price was 1.25. So right out the gate, we chopped off 100,000 in our negotiations, and it didn't end there. As you may know, rates are quite high right now in Canada, also in the U.S. I mean, rates across the board. Our interest rates on mortgage loans and property mortgages are higher than average right now, and it makes cash flow a little bit more difficult, right? Because if your mortgage payment is higher, the cash flow is lower. Just that's the way it goes. So now I want you to take a look at this deal reveal. I'm going to share the number cruncher again, like I did last week, and it's up to you to say, is this a deal or no deal? Off we go. Okay, so here it is. Let's bring up this number cruncher. Okay, so it's the exact same property, but this is ultimately what happened. When we went into the deal, we got to understand the seller's needs and built as quickly as possible a rapport with them, got to know what they were looking for. And through the conversation, they had mentioned that they were open to having us buy their, actually, it's before that. They were open to the idea of us keeping the mortgage in place, taking over the mortgage payments, okay? And this is key to the deal, okay? Why? Because as we discussed, we had put in an offer, got it accepted, and then we started our due diligence. We asked for the P&Ls, we asked for proof of income, proof of expenses, and when they finally did come in, the numbers were quite lower than what they had originally mentioned. They had mentioned that the income was 260,000, and turns out after looking at the trailing 12, the last 12 months of income and expenses, it was closer to $205,000. Okay, so that was a significant decrease in income gross, and obviously a significant decrease in net income. And so what did we say? We said, this is not the deal, right? This is not the deal that we have a 1.15 offer for. How are we going to do this? Does there happen to be any debt on the property? And turns out there is. There is a mortgage of $430,000 at 4.25%. Now, those loan rates do not exist anymore, right? Since the post-COVID rate increase, you don't see 4.25% anymore, and yet there is a 4.25% mortgage on this particular property right now, and they are in their third year of their amortization cycle. And so, for those of you who understand, and well, let me educate for those who don't. An amortization cycle starts off with you paying a lot of interest for a very little amount of principal, and the further you go down the amortization cycle, in this case, it is a 30-year mortgage, fixed rate, 30-year mortgage. Okay. Well, in the beginning, there's a lot more interest compared to principal, and the further you go, the more principal to interest you pay. So they're already 3 years into it, which means they've already paid the 3 worst years. So if we were to jump into their shoes in the third year, well, off we go. We skip the first 3 years. The worst 3 years are out. And so this may not affect the cash flow, may not affect the cash on cash return, but what it will affect is the internal rate of return. Because every mortgage payment that is done, there's more to the principal, there's more to the equity, there's more to your net worth being paid down every single month. Okay, so that's critical. And then we continued and said, okay, well, if we take over the mortgage, that's 430,000 that's financed, that's dealt with. There's still another $700,000 to go get, right? Between 1.1 million and 400,000, there's 700,000 missing. So what are our options? Yeah, we could look into our back pocket and find $700,000 and put it on the property, and off we go. And if we have time, I'll run that particular scenario for you. But ultimately, we were originally thinking of only putting about 300,000 down on this property to buy it. And now suddenly there's an option, but it takes 700,000. That's not so interesting. So naturally, and I worked the numbers with the realtor, with the sellers on the call. We made a conference call between everybody, and I worked out the numbers. And I said, listen, if we take over 430, and we were expecting to put 300, let's say 350, well, there's still another 350,000 left. And very rare are the banks that allow us to be in second position. There are some, but they're expensive. And but ultimately, there's another 350,000 missing. Would you entertain holding some paper for the difference? And they said yes. Okay. And so here we have an extra $350,000 at 10% that is financed by the seller. So notice that if we put 350 down, the seller holds 350, and we take over a mortgage of 430, well, suddenly we're at the full purchase price. How awesome is that? And we now have what we call a blended rate. We have 430,000 at 4.25%. That's the mortgage takeover portion. And there's an extra 350,000 at 10% interest only. And if you blend these rates, take a look at the formula here. If you blend these rates, this is not the right formula here. We ultimately, let me just keep it real simple. Let's say 60% of the financing of the $780,000 of financing, about 60% of that is our 430, and that's at 4.25%. The other 40% of the financing, which represents the 350, is at 10%. So we ultimately have a blended rate of 6.55%. So it's as if we had financing at 6.55% for 780,000. Right? We could combine, for the math, we can combine it into one loan at 6.55, which is a decent rate in today's market for a 30-year fixed in the US, especially in short-term rental space, especially in this type of property. So 6.55, we would ultimately still need to bring 30% down, but these are what the numbers look like, right? We are at an 11 cap, 10.7 cap. We're at a 17.2% cash on cash return. We have $61,000 a year in net cash flow. That's after the debt payment, after the mortgage. So that's $5,000 a month coming in after the debt service. And we also have a 36% internal rate of return. I'll remind you what this means. It means that if you include that the fact that the principal is getting paid down and that the property is taking value over time, appreciation at a 5% assumption here, really you're making 35% on your money per year. And you have other interesting metrics like this property is cash flowing so much that you can have twice this mortgage on it. You could have not a mortgage of 780, you could have a mortgage of 1.5 million basically, okay? So very strong cash flow. That's what it's saying here. Yeah, so far, let me know, is this a deal or no deal? Does this sound fun? Because we have a debt takeover here and we have a seller carry, right? We have both sides of that coin, which is very interesting. And this is also it's actually two of the strategies that we teach you during the blueprint, right? Our 4-day training, which we give you the basics of US real estate investing, as well as some advanced creative acquisition strategies, such as this one, to acquire your properties with as little money down as possible. Now, this down payment that you still need to bring to the table, this 344,000, can come from obviously your own cash. It could come from your RRSPs. It could come from an equity partner, a partner that comes in and splits the deal with you. It can come in with another private lender at 10% or 8% or whatever is negotiated to ultimately make this deal a no money down deal. Now, the last piece I want to say, I know I'm going fast. I hope you're enjoying it. I'm excited here. We also have a few things. How are we taking over the debt? There's many different ways you can take over debt in real estate. You can do a subject to. This is a residential property, so you can assign the beneficial interest of a trust, or you can do an entity buyout. And that's what we are targeting for this particular deal. Instead of buying the property, let's buy the company that owns the property. And this has a couple of benefits. One, you are taking over the debt in the process, and the banks and nobody really knows that there was a transfer of ownership because it's still the same company that owns it. Who owns the company changed, but the bank and all this. So how would the bank know that ownership changed? Technically, if they learned it, they could trigger their due on sale clause, a due on transfer clause. But ultimately in practice, how would they know? Do not miss your payments, because then they might find out, they might dig into why or where the payments are coming from and so forth. But ultimately, if you buy the entity, you can pick up the property that it's owned, that any properties that entity owns, and the debt that's attached to that entity, that property, stays right in place. Okay, so that's number one. Number two, another really cool thing about buying the entity rather than the property is that even the county doesn't know that the property was sold. And so typically, if you buy a property, well, not typically, sometimes, and you have to look into this, when you buy a property, the assessed value of the property sometimes is lower than your purchase price. Sometimes it's higher, but sometimes it's lower, like in this case. The county assesses this property to be worth about 500,000, meaning its tax basis is on 500,000. If we buy the property for $1 million, we can expect those taxes to double in the future. They have a very solid argument to say this property is worth $1 million. Will they jump it up the very next year? Will they jump it up quickly, slowly? Depends on the county, depends how aggressive they are, depends on the tax cycle of that particular county. Often it's every 3 years that they reassess the values based on the market data and any recent sold comps. And so all this to say, there's no sale of the property. And so the tax basis of 500 and some, that's about 600,000 on this property currently, yeah, it might just go up with some inflationary number, like 3%, 5%, something like this, but it certainly won't double anytime soon, okay? So by buying the entity, we are avoiding a $10,000 per year tax increase in the property. That's awesome. Another thing, all right, insurance. This property is currently insured. It currently has liability and insurance. It has coverage. And its insurance is about to the tune of $2,000. This is a crazy low amount for this size of a property, but they showed me the policy. I know the company, the policy is in effect. It's there. It's $2,000 a year. When I was shopping around doing due diligence and such, I was getting quotes in the 8,000s. Okay, quotes. Uh, Everything's gone up a ton since COVID, including insurance, right? There's been a couple of hurricanes in Florida recently, even Central Florida, which is typically pretty safe from these wind events. But the quotes are coming in 7,000, 8,000. That's another $5,000 savings if we buy the entity, because again, the insurance is already in place. The property's already in that entity. The property's already insured at this amount. So when you buy it, you keep it, right? If there were any lines of credits, credit cards, credit history attached to this company, it all comes with it when you buy the entity. Now, you may be buying problems at the same time. If this company has lawsuits, if this property has any restrictions, all right, and this entity almost had some actually. This was the original Harry Potter house, right? Well, the management company, the affiliate company that handles it all, not the holding entity, but like the operational company, got sued by Warner Brothers, um, Universal Studios, for copyright infringement on the Harry Potter franchise. This was years ago, right? They paid the fine. And the settlement was ultimately pay these tens of thousands of dollars for copyright infringement, fix all these things in the house, and you're okay. You're compliant, but you're never allowed to own, manage, or be affiliated with another Harry Potter house. So if that type of restriction was placed on the holding entity, right, and you buy the holding entity, you would buy that restriction at the same time, right? Now, luckily for us and them, it's not the holding company that has that restriction. It's the operating company above it. So we're free. So we can take over the entity. And so all this to say, buying the entity, taking over the debt, including seller carry for a 11 cap, 17% cash on cash return, and a 35% internal rate of return, keeping taxes and interest and insurance low in the process. Does this sound like a deal or no deal to you? I have also ran the numbers based on the past 12 months of 205,000. I kept it at 200,000 for just to have a round number in there. And this number is historically low. They have provided the P&Ls of the past 3 years, which years that included 240,000, 260,000, 70,000, 65,000, and 290,000 were the last 3 full calendar years of revenue. They happened to fire their management, and that created a kerfuffle in the schedule and everything, which accounts for the lower number this year. But it certainly has the potential to get back to 200, which is the numbers we're looking at. And maybe even if we're going to dream a little, I mean, we are in Florida after all, if we get it back to its average former glory, not the highest, but their average former glory, these are the numbers we'd talk about. 13 cap, 25% cash on cash return, $92,000 of cash flow a year after mortgage, and a 50% internal rate of return. This is a pro forma. We're far from guarantees, but this is what we're talking about here. So with all this being said, deal or no deal for you? What should we do from here? All right, who's on the call? Real quick at the top of the list. Adela, Bassam, Mariano, Nancy, SP, Surrender, Yala. What do we think? Let's hear about it. And of course, our extended Facebook family listening to us live here today. Is this a deal or no deal? All right, we get some thumbs up. That's fantastic. Okay, definitely worth exploring, and you can see the power. Oh, I didn't even do this. Let's do it. More thumbs are coming up. Fantastic. Appreciate that. What if we didn't do all this creative stuff, right? Let's just take a look at what the deal would look like from just buying it with normal financing, all right? Right now, and we got a bunch of quotes, but right now, this is one of the quotes that we received. 35% down payment, 9.5% interest. I don't like this rate one bit, but it's a real quote that I received. We would have to bring an extra $50,000 to the table to buy it this way. Taxes, I'm not going to say they're going to double right away, but they're going to go up. So I'm going to put that in there. The insurance, let's keep that 8% quote in there, a 8,000 quote. We drop from our 12 cap to a 10. 10 is still fairly strong for a cap rate, okay? But our cash on cash, all right, that mortgage payment's a lot bigger and a lot more of it's going to interest. So our cash on cash is actually lower than our cap rate. That basically means the financing is more expensive than the property really. You are losing leverage power. You're losing dollar for dollar power by using leverage. That's what it means. Our cash flow is not in the 70, 80, 90,000. We're at 36,000 a year. So that means we're getting $3,000 a month of cash flow after putting 400,000 down. And our internal rate of return is nowhere near the 40. We're in the 24%. So can you see here how we are basically doubling the deal's profitability by doing it in a creative way, even paying the seller 10% on the mortgage on 350,000. We are almost doubling the internal rate of return because it was 40 on the other scenario, right? And it was with the same rental income. I brought it back down to my 200,000. I'm not comparing the pro forma to this scenario here. So that's the power of really understanding the mechanics and the strategies that we can use in US real estate, between taking over debt, having the seller hold paper, or deferring our sale to a future date with some special terms to ultimately double the deal. It's as simple as that. And that's what really excites me, when you can create these type of numbers on $1 million property, and of course, say you're the owner of the Wizard's Way, right? That's pretty cool too. So anyways, that's what we have for you today. That's our deal reveal. Hopefully you enjoyed. I would like to remind you that if you want to learn about all this, you can. If you haven't already joined our Epic Blueprint, it is available for you right now. n4t.club/blueprint. n4t.club/blueprint. You just go on there, you sign up. For what you're going to learn, the price is ridiculously low. We have done everything to keep it as low as possible, but learn the basics. There's a right way and a wrong way to do this, and you absolutely want to do it the right way. Epic Blueprint. That's our deal reveal. Join us.